Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're talking about the basics of Series I bonds. But first, if you're looking for a year-end tax update, check out Spidell's Federal Tax Update webinar live on January 5th and 6th, which will cover all the most important tax law changes that happened in 2022. You can see a full list of topics and get registered at spidell.com under the Webinars tab. The interest rate on Series I U.S. savings bonds is set at 9.62% for the second half of 2022, and they're starting to generate a lot of buzz in the financial services world. So much so that many tax professionals are starting to receive client phone calls asking about directing a portion of their refund to purchasing them. With the stock market still struggling and interest rates rising, the prospect of receiving a guaranteed 9.62% rate of return while inflation rates are so high is appealing to many. A Series I bond is a security that earns interest based on both a fixed rate and a rate that's set twice a year based on inflation. The bond earns interest at an adjustable rate until it reaches 30 years or the holder cashes it in, whichever comes first. There are a number of benefits to Series I bonds, for example, inflation protection because the rate is a combination of a fixed rate plus an inflation rate. They're low risk because U.S. Treasury bonds are considered one of the safest investments possible. Interest income is exempt from state and local taxes and can be deferred up to 30 years. Interest is compounded semi-annually. And if interest rates drop, taxpayers can redeem the bonds and invest their money into higher earning investments without penalties. Series I bonds pay interest for up to 30 years and are generally not paid until the bond is redeemed. The holder of a Series I bond can elect to receive annual interest payments. Investors can each buy up to $15,000 of I bonds annually, $10,000 electronic plus $5,000 of paper bonds. The limit is based on the purchaser's Social Security number, so both spouses in a married couple can each purchase up to $15,000. Even children can purchase up to $15,000, or the bonds can be purchased for them. Taxpayers can use Form 8888 to purchase up to $5,000 in Series I bonds using their income tax refund. Series I bonds are the only type of U.S. Treasury bonds that can be purchased directly with an income tax refund. Form 8888 can be used to direct refunds to purchase Series I bonds for taxpayers or anyone else, such as children or grandchildren. Series savings bonds, as well as Series EE bonds, also have an education exclusion that allows qualified taxpayers to exclude from their gross income all or a part of the interest paid on redemption of their bonds when the bond owner pays qualified higher education expenses at an eligible institution. The exclusion is calculated on Form 8815 and is reported on Form 1040 Schedule B, Line 3. The income exclusion applies if all of the following are true. The bonds were cashed in the same tax year for which the exclusion is claimed. The qualified higher education expenses were paid for by the taxpayer, spouse, or dependents. The taxpayer's filing status can't be married filing separate. The taxpayer's modified AGI was less than $100,800 if filing single, head of household, or qualifying widower, or $158,650 if married filing joint, and the taxpayer was at least 24 years old when their savings bonds were issued. The age requirement for the interest income exclusion can be confusing. It's the taxpayer claiming the exclusion who has to have been at least 24 years old when their savings bonds were issued. You'll get news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year with a subscription to Spidell's quarterly Federal Tax Update webinar. You can register for the series or for a single session at spidell.com under the Webinars tab. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.